Hi there, everyone. Welcome to our end of April edition of On Track. Rob McGregor here. It's the 27th of May, recording this from sunny Noosa with performance figures up to the end of April and news and charts right up to the date that we're speaking. As we go into today, they've just announced a 7-day lockdown in Melbourne. So fingers crossed over the next few weeks that locks it out of the system. I'll talk more about that. As always, just a general advice warning. What that means is this video is designed for clients of McGregor Wealth Management. If you're not a client of McGregor Wealth Management, don't take anything here as personal advice. You should get advice before acting on anything. I'm going to go through some of the latest news, put it into context around the markets, talk about the returns, have a look at where vaccinations are up to around the world, some quick news on the Australian budget, and have a look this month at what's driving property markets around Australia. News highlights. We saw a big spending Australian budget, probably needed. I'll go through that in detail, or in a bit more detail. We've seen the start of inflation worries in the US. And what that means, we haven't seen it in Australia yet, but we're still sitting on end of March figures in Australia. We'll see what happens when we get to the end of June, the quarterly figures. In the US, their inflation figures hit 4%. Now, it's predicted to be transitory. What that means is it's temporary and will probably come down. But people start to worry about inflation coming back in and what that might mean for interest rates, wage rises, and all those things. It's early days, but certainly we're seeing some slight tick up in interest rates. We're not seeing it in Australia. When we look at the table on the right here, no change to cash rate, no change to 90-day bank bill rate. The 10-year government bond yield is actually down slightly. No change to exchange rates or our inflation, although, as I said, that's still end of March quarter. Mortgage rates unchanged and one-year term deposits unchanged. What we are seeing, and I talk about here, fixed mortgage rates are sneaking up. So you can see this chart down the bottom, looks at 1, 2, 3, 4, and 5-year fixed mortgage rates. And you can see up until sort of 2020 and COVID, we were sitting at around 4 to 4.5% of fixed mortgage rates. And we've seen that tumble massively. But in the last little bit, you can see the long end, the 4 and the 5-year rates, just starting to tick up a little. Still incredibly cheap, still the cheapest, almost the cheapest they've ever been, but just starting to tick up. And that's probably the market saying, hey, we think we might be starting to come out of this. We might see some interest rate rises eventually. We've seen Bitcoin kind of crashing, massively volatile. I'm not going into that too much, but where that does affect the portfolio, we're seeing some of the money coming out of Bitcoin going back into gold, and we're seeing it coming back up. And yeah, I'm going to talk more about vaccination rates around the world, and Australia's pretty slow, although in Melbourne all of a sudden it's hopefully going to increase. I'll talk more about that in a minute. But this other chart on this page shows kind of what's driving property prices at the moment, and it's just the fact that people are borrowing. So this chart shows new lending commitments for investment, the yellow line, and the blue line is for owner-occupied dwellings. So you can see that people are borrowing to buy new houses. That's largely driven by new home buyers, but also other people upgrading, moving, buying second homes. So it's only partially driven by investors. So this is very much about people upgrading or buying their first home. So let's jump in. The results continue to be good. 1 month results, good and consistent. You never read anything into 1 month results, 3 months, etc., but they're there for information. Our long-term targets absolutely being met across the portfolios with very solid 3 and 5-year returns. We have the market that assessed overall at just over fair value. That's with the low confidence given interest rates are so low. If you thought interest rates were staying low for a long time, that would mean markets are actually very cheap. So the big unknown is interest rates. So we believe the markets are in a very safe place for investors, and anyone who's a bit cautious can just drip feed in a little by little, but certainly not too hot, we believe. Budget highlights. So the federal government brought down their budget a few weeks ago now. It reiterated the world's now in the second year of the pandemic. Australia's economy has recovered better than we expected and better than most. In fact, we're the top performing economy out of all the developed nations. So quite amazing for a few reasons. We've spent that extra growth. So the mid-year estimates they did last November, when they did the budget, they thought we'd be in a lot worse position. We're in a lot better position, and they've decided to spend that money on extra stimulus. And I'll talk about some of those things. We're going to have deficits for more than a decade. So no budget surplus for at least a decade. They're prioritising jobs over austerity, and austerity just means trying to balance the budget. It's a humane budget. Cynics might say it's an election budget, but they are trying to keep the economy going. And we probably will see an election possibly before the next budget next May. Government debt's rising. It's 40%, rising to the 50s over the next few years. I'll put that into perspective in a minute. And we're seeing in the budget strong infrastructure spending and lots of incentive to spend and to innovate. Just to put in perspective, when I do the budget presentations, I always make sure we know what $1 billion and $1 trillion actually is. Australia's got about 26 million people. Now, $1 billion is 1,000 million, so that equates to $38 per person. So whenever you hear someone saying we're borrowing $1 billion, that's $38 per person in Australia. A trillion is a million, and that equates to 38,500 per person. So when they say we've got trillions in debt, we do, but it's 38,500 per person, to put it in perspective. And just to keep that in perspective, our economy, GDP, is just over $2 trillion. That's 77,000 per person. And yeah, just in terms of, actually I'll talk about, look where we sit on this ladder of countries. So Australia sits about number 9. This is in US dollars. So at about 62,000 per person. So we are, make no mistake, a wealthy country. Some of the countries at the top here are tax havens. So you discount that to a degree. But yeah, top 10, we're a wealthy nation, and billions and trillions in perspective there. Some of the highlights from the budget, the top chart here is iron ore prices. So iron ore prices a few years ago were expected to be at $70 US a tonne. They've risen massively, partly because of shortages coming out of the competitors, particularly in Brazil, the Vale mines there. So that's led to a lot of extra revenue for the government, which they're absolutely spending. And so better revenue than we thought. They're still predicting iron ore prices to drop back to about that $80 US, and that will see us get a bit less revenue. Who knows how that's going to actually play out. The big news is that unemployment has come down much quicker than anyone expected. So that's now factored into the budget, and you can see the spending and the revenue. The fact that the red line here is more than the revenue means we run deficits, which means we lift debts. And you can see these deficits. And to put it in perspective, they're much, much smaller than during the World War I and World War II. This has been a kind of a war, a very weird war, a war on the pandemic, and it's resulted in governments having to spend to keep the economy going. We are the lucky country. We've done way better or less worse than most other countries around the world. Our GDP is only 2% below pre-COVID levels. That's up to the date of the budget. Much better than the UK, Italy, etc. And as you look across there, the US has done particularly well as well. Some of those reasons that we're the lucky country, we've kind of had a good COVID result with the reasonable response. We're partly lucky being an island. We've had a pay rise from iron ore. We've had a cost cut because interest rates are low. So the government debt, they don't have to pay as much money on that with low interest rates. Some of the key budget initiatives, we've seen an extension of what they call temporary full expensing. That's where businesses can buy, invest in capital goods and write it off for tax straight away. So that's led to a lot of money being spent, which is good for the economy, and that's been extended for another year. There's a lot of incentives to try and keep innovation in Australia. Our track record is Australia is a very innovative country, but often the technology ends up overseas. So they're offering tax concessions to new patents and innovations that stay in Australia, and a few other incentives there. They're extending the tax cuts, so lower taxes for everyone, increasing childcare subsidies for those with more than one child in childcare, and they're spending big to reform aged care, $17 billion. Remember, that's $38 per person times 17, 2.3 billion on mental health. So that, $2.3 billion, to put that in perspective again, is about $80 each on mental health and infrastructure. So even though it sounds a lot, it's not huge when you put it in perspective. And they're continuing with the extended home ownership programs. So that's going to continue to drive those property markets as young people and first home buyers can access those grants. They'll be out there, while interest rates stay low, it's very attractive for them to be buying property. So let's put it all into context. As I said, the market's grinding up nicely in the wall of worry. We've got it at just over fair value. We've well and truly recovered from this downturn, and you'll see that when we go through the numbers. But firstly, a quick comment on the vaccine rollout, and you'll see an update here on the countries that have vaccinated, and certainly this is a tally that Australia features in higher. I had to add in Australia and New Zealand, and you'll see how low we are compared to the world, and Japan, interestingly, where the Olympics are going to be. So countries that have done well on virus cases are vaccinating slower because their populations are apathetic about getting it because we don't have COVID visible. India's ticking up now in their vaccinations. But you see, have a look at the difference between two countries with very similar populations, Israel and New Zealand. Israel had massive waves of the virus. So in their third wave, up to 6,000 to 7,000 cases a day, Israel's been ahead of the curve from the virus. And you can see in terms of vaccinations, and you can see that's come down to where they've now only got about 48 cases a day. While that sounds high for us, it's very low for them. So they're at the tail end of that with the vaccinations and herd immunity doing the job. Contrast New Zealand, which peaked at 80 cases a day. New Zealand now has next to no cases. They all come out of hotel quarantine. That means New Zealand's vaccination rate is only down at around 6%. So once again, these countries that have done it well, like Australia and New Zealand, are not doing so well on the vaccination. And that means we run the risk of being closed off to the rest of the world if we don't get our vaccination act together. Just for information, I had my vaccine last week. No side effects. That was the AstraZeneca one. No fear from me or my doctors. Everyone's got their own choice on these things. But yeah, it's going to be, for the world to open up, we are going to need pretty high vaccination rates. The UK is interesting. They've also had a great, better vaccination rollout, right up the top of the chart here, about 55% of people, and you can see the massive drop in their COVID cases. India, whose COVID cases gone up, looks like it's peaked and coming down. Not that you'd know that from the news. The news is more interested in reporting total cases rather than new cases. So the drop is good there, but we'll see how that plays out. A reminder about process. I won't go through that in any detail. You've heard me talk about that before. The mess it up we're still seeing. We're still seeing this massive, never before have I seen such a short-term focus on a single issue of COVID. It's still dominating everything. And you could say rightly so, but the biggest issue for investors, it can cause them to lose track of the big thing. I was talking to some clients this morning and how surprised they were that the markets have come back so well. And it's pretty much the simple reason that markets have come back so well is that people have still spent their money. So we didn't lose as many jobs as we thought. You saw that from the unemployment numbers I went through before. And those of us still earning our money couldn't spend it going overseas, but we've been massively spending it in Australia, home renovations, Bunnings, gardens, cars, caravans, boats, all sorts of things, local holidays. So that's kept the economy going well. So good long-term news for all of that. Let's have a look at how each of the individual markets went. Australian market was up last month, continued to be grinding up slowly higher in that wall of worry. You'll see on the 5-year chart, we can see that big drop for COVID now fully recovered, much quicker than anyone anticipated, although we were always confident that we would recover sooner rather than later. You can see the top 10 holdings in the Australian market through VAS, the ETF that we own, and you can see here the 1-year returns on various companies. And look at the recovery of the banking sector. ANZ Bank up 90%, CSL down 1%, so what a turnaround. This is the reason we like diversification, because we get to hold all of these, and we're seeing that come to the fore. So US shares also up just over 3%. US market's still well above now where it was pre-COVID, largely driven by a lot of tech companies. So the big companies in the US, Apple, Microsoft, Amazon, Facebook, Google, Tesla now up there, and then some of the more traditional companies, Berkshire Hathaway, Warren Buffett's company, and you can see their 1 year return there. Look at Tesla, 270%. Tesla's been in the news a lot lately, not so much about the cars, but about Bitcoin, and that's caused the Bitcoin market to be all over the place. Once again, that's a highly speculative market that we stay away from just because we don't advise on speculation. We know some people have dabbled in it, and that's fine. Our philosophy is pretty simple there. Play with money that you're okay to lose. Let's have a look at US small caps. Yeah, a 1 year return of 49%, absolutely staggering. Keep in mind the 1 year returns are coming off a low base. So the 1 year returns now coming from around here. So the market had jumped about 50% off the bottom, but still a great result. And yeah, the 5 year return about 15.5%. A very important part of the portfolio. Less familiar companies here in that portfolio. Global leaders, so this is the top 100 companies in the world, also good results, and you'll see once again those big companies in that portfolio. And yeah, you can see here I've marked with an X where the 1 year chart starts here. So you can see, yeah, this time, if I was speaking this time a year ago, as I would have been, we'd done the big bounce back, and then we were hovering around waiting to see what was going to happen next. And that next has just been a slow grind up the wall of worry, and nice recovery for all of our portfolios. Emerging markets have had it tougher. They've gone a bit sideways in the last few months, but still really good over the last year and over the last 5 years as well. So an important part of the portfolio. You'll see some of those emerging market companies there. So these are big companies like Taiwan Semiconductor, Tencent, Alibaba, Samsung, etc. Look at gold. So gold has done the opposite of everything else. It went, it was heading up, it came down during the COVID world, it was drifting lower. But as Bitcoin's crashed, gold is starting to go up. So some of the hedge funds that put some of their hedging money into Bitcoin, that money probably came out of their gold allocation. And as Bitcoin's starting to come down, at least for now, I suspect they've put some of that money back into the more traditional hedging of currencies, which is gold, and we've seen that go up. So that's helpful in our portfolios. Property, look at this, a sea of green. So not one city in Australia that's not up over the last month and up over the last year. The leaders there, you know, Darwin, 15%, 18% in their housing market, 16% Canberra, 14% Hobart, and Brisbane, 10% Adelaide. This shows the capital cities. There's a lot higher returns in regional places, including here on the Sunshine Coast, which is probably up between 20 to 30%, depending on suburbs. So yeah, a sea of green. That's reiterated in our friends from Harry Todd White's Property Clock. Pretty much everything they classify as a rising market. There's a few outliers, regional WA, and Wodonga started to decline. I don't know that market well. I don't know the story there. And a few areas that they're saying may have reached their peak, and they tend to be regional places that have done particularly well, by the way. So Launceston, Burnie, Devonport done well. Hobart's still going up there, but Tassie's certainly reached, yeah, looks like it's very far ahead in its cycle. Unit market, much the same. So the story is everything's going up. The magic question, how long will it keep going up? I can't answer that, but let's just say for lots of markets, we're probably more mature in the cycle. And often we get our total return in 2 to 4 years. The full cycle runs anywhere from 12 to 20 years, but we see most of the return concentrated in sort of 2 to 4 years. And fair to say for some markets, we've probably seen most of the cycle return. That means we may see some flat periods ahead in the more mature markets, and you've got to look out to places like Perth, but even still Brisbane, where they haven't had as many gains. For those that are buying, we'll be helping you find the safer places. It's a complex world. In the long run, most capital city markets will do well. It's just wanting to see some results in the short run. So that's it for this one. Just reinforce reinforcing our process as always. You know, all our plans, all our investments are based on your goals, what's important to you. Portfolios designed to meet those goals. We take a long-term view. The three big secrets: diversify, 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 get the right asset allocation, have enough liquidity to ride through the process, to ride through any crisis, and low cost index for most markets. We protect against that inevitable short-term volatility with our reserves and dollar cost averaging for people accumulating their wealth. We rebalance regularly. And just a reminder, those three ways to lose money, not to do them, that's panic and selling. And once again, congratulations, not one of our clients panicked last year, so everyone's seen their portfolios recover beautifully. Having to sell, and the reserves make sure we never have to sell, not properly diversified. Thank you for listening if you've made it to the end. As always, send me any feedback on things you'd like to hear about, any interpretations. Look forward to catching up with you in your next review. Until this month, I will see you later. Have a great day.